Good morning. This is Dylan Jovine with Behind the Market. Happy Tuesday. Today is Tuesday, April 1st, and I want to start off with a very sober message this morning and let you know that we are closing up shop and I am retiring. I've decided to retire after many years in this business, after 30 plus years in this business. I'm just kidding, April Fools. Today is April Fool's Day. So April Fools is one of my most enjoyable little holidays out there. I go to extraordinary lengths to tease my kids and to get everybody in my circle fooled just a little bit on April Fool's Day. Lord knows why this is even a thing, but it puts a smile on my face every year. Today I want to talk about an economic indicator, a reading that we got that's been pretty startling. And the headline is U.S. auto repossessions hit levels not seen since the great financial crisis. And auto repossessions, basically car companies taking their cars back because the people who bought them have been unable to pay for them, have hit the highest level since 2009, 1.73 million annualized. They rose by 16%, the highest since the 2009 financial crisis, the last year of the financial crisis. And again, car repossessions means that the lender takes back the car who's defaulted on their loan payments. And to put this in a different way, Americans are defaulting on their car loans at a rate that hasn't been seen in a very long time. And the share of subprime 60-plus day delinquencies on auto loans surged to 6.5% in January, which is the most on record, which is crazy. So Americans are really falling behind on their car payments, which is not great. And it goes on further to say the auto loan serious delinquencies, 90 days or above, serious delinquency rates hit 3% in the Q4 of 2024, the highest level in 14 years. And that really tells you that the consumer is under strain. And Walmart also had a piece out last week. Walmart CEO Doug McMillan says customers are exhibiting, quote, stressed behaviors. And it says they're starting to see that people are spending less money per visit. If you're Walmart, what you do is you look at the average ticket price, average order value. So when somebody comes there that they spend, let's say they shop once a week, they spend, we'll call it $124 a week. And that number has gone down from 124 to 103. They also starting to see that consumers are selecting cheaper options, store brand options or off brand options instead of, let's say, going for Kellogg's cereal cornflakes. They go for Walmart branded cornflakes or whatever brand Walmart has invented to sell cornflakes. So they're becoming very price conscious, which tells you that you have consumer spending that's under pressure. And again, that tracks with consumer confidence hitting a 12-year low that we saw last week. And these readings are telling us that the consumer is getting tapped out. And remember something, just to put this into context. In 2020, we had these stimulus checks. The Trump administration spent trillions of dollars sending out checks for people sitting home, which of course, all you people I know were so happy to get these checks. We know that the knock-on effects of that were inflation. And of course, Biden, not to be outdone by Trump sending out trillions of dollars in checks, Biden said, hold my beer, and one-upped him and sent out additional trillions of dollars after the economy was already on track. So we've had two administrations in a row over the past 8 years send out trillions of dollars in money to people. And we've seen the effects of that in terms of inflation. You can't send out checks without it causing inflation. So everybody got the check that moment. They were so thrilled to get it. And then, of course, a year or two later, the value of everything, the value of the dollar had gone down by 10% a year for 2 years, which is the way that kind of works. Talk about impulse control. Talk about short-term happiness, but long-term pain. We've had two administrations that have just spent and spent. And consumers got all that money in 2020, 2021, 2022, and they've spent down those, what would they call pandemic savings. And now they're starting to really strain as a lot of these prices haven't come down. And certainly we're starting to see, as the Fed has talked about, increases in prices due to the tariffs that we're starting to see. Basically, countries that are importing to us, let's say like China, is passing on their 20% tariff that Trump smacked on them, and they're passing it on to consumers. So we're starting to see these products that we're buying, where let's say you go and buy a couch or a rug or a microwave or whatever it is, and it is higher than it was 2 months ago. So that is starting to really slow the economy down. And you're starting to see that, which is, of course, that exhaustion is starting to hit the markets along with this whipsaw tariff policy. And, that consumers, this is very important because consumers account for about 70% of productive activity of GDP. So consumer spending drives growth. Consumer spending drives the economy. So when consumers spend less, that means economic growth slows, and that means business profits suffer and the stock market goes down. And again, we've talked about this. We're starting to see the effects of this, where you're starting to see inflation, people have less money, their dollar doesn't go as far, they start to pull back on spending. This is a time-worn tradition, this playbook. What's happening now is like a slow-motion car wreck. We've seen it many times before. And, right now, when you look at really savvy investors who share their stuff, they have at least 30-40% of their money in cash. Not cash. Cash is actually a terrible investment. But they have it in money market mutual funds that invest in U.S. Treasuries. And, of course, in our Midnight in America book, we lay out the 3 options, the 3 best ones, in our humble opinion, that you should be invested in. So I want you to pick up a copy, because unless this market changes dramatically, we're going to see a little bit more of the same. But again, with Trump in the White House, you can't really put all your eggs in one basket, because he could change his mind any day, and all of a sudden things change. So you just can't be completely bearish or completely bullish. But we were never completely bearish or completely bullish. We take an objective look at things, and we look at the positives, and you still have strong economic growth, and you have AI rollout, and you have data centers going out and demands for energy and all these things. And we look at the negative, which we have the tariff policies and the incredible spending and all these other things. The consumer is really getting tired. So we have a very much a mixed picture on Wall Street here. But until it swings positively or negatively in one direction or the other, we're still going to have a market that really is just deflating, blah, 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 blah. And that's what we're dealing with here. Anyway, happy April Fool's Day. I'll see you tomorrow.